Isom, great to have you on Beer with the CFO. Thank you for joining us.
Thanks for having me.
Yes, of course. And you suggested the Fairy Nectar from Cross Strain Brewing. Am I saying Cross Strain correctly?
Yep, that's right. It's a Nebraska brewery here. Fairy Nectar, which you can't really see with my virtual background, is their most popular beer.
Wonderful. You also suggested the Boulevard Unfiltered and the Allagash White. So they sent me the Boulevard Unfiltered.
Perfect.
So cheers to you, Steve.
Cheers.
And
I'm from Kansas City, so I'm a big Boulevard fan.
Oh, wonderful. Okay, that's delicious. Thank you for suggesting that. So we've got some new beers that our CFOs and our audience can go test. Today's topic is 3 tips for your recession survival guide. Steve Isom is the CFO of Bloomerang, which is a donor management and funding software company. Their customers raised over $8 billion last year, and Bloomerang has tens of millions in revenue with about 300 employees. Steve was integral in raising $40 million in funding from CIBC in Innovation Banking, and also was part of an acquisition of a Tennessee-based company called Kindful. Steve, welcome, and we appreciate you joining us today.
Talking about everyone's favorite subject, recession, the big R word.
Right.
Yeah, I know a lot of people. A lot of people are probably thinking about at this right now, and probably some sleepless nights. But we are going through a really massive reset in the market, and depending on how long your career is, there's probably a lot of folks that haven't really experienced this or operated through a downturn. And I think the real thing to call out is just with the reset in the market and rising rates, cheap capital and growth at all costs is kind of off the table at this point. So it's been kind of the operating environment for quite a while now, and I think both in the public markets and a little bit less so in the private markets, we've shown it's much more a balance now between growth and profitability. And you could even argue in the public markets, more of a focus on profitability. And that is something that hasn't been the case for quite a while in the market.
Right. We were talking about growth, and you were with Flywheel before you came over to Bloomerang. You were the lead VP of finance over at Flywheel. At that time, you're a Consero customer, and you exited to WP Engine successfully. So you've been on the exit side, and you've been on the acquiring capital and acquiring companies side. We had all this dry powder back, 2020, 2021, and we got to say cheers to your doggy over there too.
Sorry about that. Wouldn't be a remote without a dog barking. Sorry about that.
That's right. It's the world we live in now. You have a lot of experience in different ways, both on exiting a company, acquiring capital. What would be your 3 tips, if you can provide our audience, with a few practical tips to prepare your organization for whatever economic conditions are around the corner? If you could pick 3, what would you say?
Yeah, absolutely. So I'll say kind of one overarching thing that I'm not going to include in my 3, so I'm already cheating, and I'm going to say 4. But one I think is really important is kind of setting the tone or resetting the tone internally at the company and with the employee base and the leadership team. High growth technology companies like Bloomerang, Flywheel, WP Engine, right? Really young employee bases, and have had a lot of their career in there was really go time in the market. So, really getting and explaining brass tacks of kind of what's happening, why interest rates rising impacts high growth technology companies. And you don't necessarily need to go so in the weeds of explaining, well, when you buy a high growth technology company, you're making an assumption around discounted cash flows and the terminal value and what happens when the interest rate goes up. But I do think there's an element of explaining to folks why cheap capital kind of going away impacts these businesses. But that's kind of like setting the tone overall. I think the 3 things is all about really understanding your business. So first of all, as we've kind of entered into this uncertain times, I think most people have gone instantly into or should go into scenario planning, right? You kind of throw out your original plan for the year or maybe multi-year plan that assumed, the good times were going to keep rolling. and start to pressure test what your top line looks like and your bottom line. Your number one goal as a CFO or finance leader is don't run out of money, right? So first and foremost, like, you have to take care of the company, protect the house, and make sure that you've got enough runway to operate. So I think really starting to work with those scenarios, I'd caution you not to over-index, right? Of like, understand that, when COVID first started, I know, the company I was at, we did a lot of scenarios, right? But the uniqueness was like, it's a high, medium, low case probably, and understanding how far that gets you. And then as part of that is really making sure you understand unit economics. So that's kind of number two, right? So one of the things that's happening in growth at all costs is there's companies that still have strong unit economics, and you could justify spending and burning money in the short term if you knew over a long term you're going to get paid back and you're going to retain those customers, and the customer lifetime value justified it. But I think that in kind of the froth that's happened in the market, there's also really unhealthy unit economics at businesses that are getting thrown in there. So really understanding, okay, what's it costing us to acquire a customer and how much is that customer worth? So that you can be really informed about, okay, you've got those scenario planning, but like, is our long-term operating model even viable at this point in the market, right? If we don't have access to unlimited capital or near unlimited capital. And then the third thing is just the easiest thing, and I think this probably comes the most naturally to a lot of CFOs, is just getting a handle on your spend. So really looking at a full inventory of the vendors that you use, what's negotiated, what can you get out of. Most people should kind of be in this rhythm already. When we went into COVID, a lot of people pulled back. People were trying to get out of leases. But I think software spend has been an area where we've looked a lot at duplicate tools, underutilized tools, excess number of licenses, and really working back, and found that you can kind of make some cuts, because the hardest thing, right, is making hard cuts, and hard cuts tend to be, laying off folks, and what I like to think is like, okay, what's the least painful thing, and then kind of work your way down. And obviously not hiring a net new role, that person doesn't work for you yet, so that's an easier thing to cut. Or underutilized systems or redundant systems, that shouldn't hurt as much either. And you kind of work through that gradient of pain internally. And I think obviously it all just depends on the specific situation that your business is in.
Yeah, uncertainty makes it very difficult to plan.
Yeah.
Do you have any advice for CFOs who, you're preserving cash, you're looking at your cash burn rate and things like that, and looking at areas where you can scale back licenses, etc., software, duplicate software. How can CFOs look at opportunities in trying times, similar to your acquisition that you did of Kindful this past year? And in the past year, Consero helped our clients with over 50 add-on acquisitions. So that was really prevalent in 2020, 2021. What advice can you give to CFOs that can look for opportunities in trying times?
Yeah, so all the things we were talking about before is kind of like the reactive, protect the house mentality. But if you're in a really strong position, you've got a lot of runway, you have strong economics in your business, even better, you're profitable. The uncertainty in the market is an opportunity, right? And to really lead from a position of strength. So I think that we acquired Kindful, and the market was still roaring. It just made a lot of sense to bring those two businesses together. We brought the online fundraising capabilities into the donor CRM sweet spot that Bloomerang had established over the last 10 years, and it's been a great acquisition. But I think what's going to happen probably over, let's call it the next 18 to 24 months, is you're going to have a lot of smaller businesses looking for a home. And that's probably businesses that, hey, maybe as the private capital markets dry up a little bit, it starts to become maybe more apparent that maybe it's not a company, it's more so a product, or maybe it's not even a product, it's a feature, and companies need to find something that's stickier within a customer base as opposed to just something that they can cancel when times get tough. Bloomerang, we are the system of record for our customers. It's not something you can kind of just cut as discretionary spend. You kind of need it. Our nonprofit customers need our software really to do their jobs. So I think there's going to be an opportunity for tuck-in acquisitions for companies that are in strong financial positions. And I think that's really, you look at the last great financial crisis, a lot of fantastic technology companies were built then. They were great opportunistic acquisitions. So I think that once you kind of get your own house in order, and I think that has to happen first, right? Make sure you get the oxygen mask on yourself first. And once you feel good, then you can start looking outward and see like, maybe there are some things that make sense for us. And we can actually kind of come out of this uncertain time even better than we entered it. The other thing is, even if your business is in a really strong position, high inflation, market uncertainty, SMB trading down is just a good excuse to reevaluate the things that you've been doing, right? And it's a little bit of a crutch for a CFO, though, to be like, oh, given what's going on in the market, but there's probably a lot of CFOs who are saying, oh, we've been spending too much money on this for a while already. But there is kind of just a more accepting view across the board if people understand, hey, there's like, especially if you're in a relatively strong position, right? So like, hey, the company we're at right now, we're hiring, we're growing. Bloomerang just had our best sales month ever, right? So like we have a lot of positive momentum, but that doesn't mean people don't have friends or former colleagues that are working at companies that are doing layoffs or having big misses. And it's like, it's kind of a good time to just kind of ask everyone to reassess kind of what the things they're doing and are you getting kind of the payback on those investments.
And talking about investments, not only acquiring companies, but looking at new, maybe VC or private equity or debt financing. How important is it for a CFO? And keep in mind, a lot of the folks in our audience, they're new CFOs. They may be CEOs who are with a smaller growing company, and they're overseeing the financials until they can build a finance team and get a CFO in place. So how important, what advice can you give, and how important would you say is it to have audit-ready financials for both that exit scenario, like you did with WP Engine, or when you're looking to acquire more funding?
Yeah, absolutely. So very important is the answer. I think that oftentimes, especially if you're a smaller business, so let's say you're a couple hundred employees or smaller, larger strategic acquirers or investors aren't expecting perfection, right? Or necessarily expecting you to be at that level. But oftentimes what you're doing, right, is you're kind of having preliminary discussions, and you're oftentimes finding a strategic fit, and maybe you move into a term sheet, and then it's confirmatory diligence after that. And confirmatory, that word is really important, because basically what it means is like, hey, we're going to take all of those things you're telling us upfront at face value, and then we're going to trust but verify, right? And the financials is like the number one thing of like, hey, we just want to make sure what you told us is right. So you said revenue was one number, like we just want to make sure. And like you said, you're burning this much, and we want to make sure. And we just want to make sure there's not like any massive red flags as we go through our diligence. So like this whole idea of confirmatory diligence for companies of, I'll call it our stage, are really what matter. Now, the larger you get, I think it becomes, more important. But what I often tell first-time finance leaders who are going through maybe a first-time capital raise or getting acquired by a much bigger company is a narrative is also really important, right? So I always opt on like full transparency. So, when Flywheel was acquired by WP Engine, we were in such a much better position than when I first started. But we were on a journey of increasing sophistication, of finance, accounting, billing, legal, right? And I was able to kind of tell the story of, hey, when I joined, here's where we were. And over the last, do the math, like 15 months, we did X. And here's where we were planning to go if this deal wouldn't have happened. And I think that, my at least opinion was that it gave you some credibility on, one, you had a handle on the situation, as opposed to, hey, a buyer comes back, they said they're doing a quality of earnings with a third party, and they found kind of these issues and they want to ask these questions on it, as opposed to you proactively telling the buyer or investor exactly where you are, where you've been, and where you're going. And I think that's how you lead from a position of strength. But you have to have that base level, like you have to have financials in a reasonably good position, whether you're audit ready or you've been audited. And it doesn't have to be perfect, right? But there's also just a ton of value in knowing where you aren't perfect and you being able to proactively communicate that.
That's great advice, having that narrative. And, we see it all the time. The longer it takes to produce those financials and the more questions that arise and the longer the deal goes on, then things get a little sketchy and may not go in your favor. Talking about economic downturn, my final question for you is there a time when looking at a third party or an outsourced provider leveraging a third party for maybe a certain function might be a good choice in scaling back expenses or leveraging their expertise rather than trying to build that function in-house?
Yeah, so I think a lot of folks probably who are listening to this or watching it, or existing Consero clients, were in a similar position of me when I joined Flywheel. It was a little bit of a triage situation. I think there's a Flywheel case study still on the Consero website, but I joined. There was one person who's kind of the jack of all trades, doing everything from journal entries to billing to payroll, benefits, and she resigned. And I had pitched myself, hey, Flywheel, I'm the strategic finance leader. I'm going to help you think about the future. I'm going to help you raise capital. We're going to sell the business. And day one, it's like, hey, I need to make sure vendors get paid. That's not necessarily like the high value work that you pitch yourselves on. And, at the time, I think I had never had like a really great experience with outsourced services. So I stubbornly put my head down and went out and tried to build a team, and I wasn't having any luck. And I was lucky, I got a really great referral to Consero. And I think Consero is one of those things, and I know this isn't intended necessarily to be a Consero commercial, but Consero is one of those things, like you have to talk to other people who are clients because it kind of sounds too good to be true, right? It's like, well, wait a second, I can get, really standardized accounting procedures, get this spun up really quick, and it's just as good, if not better, than an in-house team. And I was super skeptical, so I talked to other clients of Consero. And I think what it allowed us to do at Flywheel was to triage the situation and get it spun up really quick. I think that there's kind of two things where Consero is like kind of the no-brainer. One is you have time pressure, right? It's harder than ever to hire. Certainly hard to hire really great people. And with Consero, you kind of know what you're getting. You're really getting really high quality work. And the great thing about Consero too is I just love that it's not like a typical outsource firm where it's like, hey, tell me what you're doing and we'll take it over, right? And we'll just keep doing it the way you're doing it, right? It's like, no, it's an opinionated approach of like, here are the systems and processes we're going to put in place so that you can scale. Also, the systems and processes in place that a buyer or an investor will recognize as being, normal for the industry. And then the other piece is if you're trying to cut costs, right? I think for the economic model and outsourcing, it makes a lot of sense. It was one of the things when we got acquired at Flywheel, I think the initial instinct was like, oh, we have an accounting team in-house, so we'll just cut Consero immediately. And I think that it took just kind of a few months of operating to realize like, oh no, this is just as good, if not better, than an in-house team. Now, I will say the one thing though that I've been super opinionated about in every customer referral call I've always done about Consero, and I don't know if this really mattered, but I'm going to continue to say it matters. We treated our Consero team as if they were full-time employees, right? We sent them flywheel t-shirts, we sent them, updates on financial performance. Like, we embraced them as part of our company. And I think what we found is when we were in a situation where we needed them to step up, and I'll shout out my guy AT, like AT was always there, like, hey, we got a diligence request list from Deloitte. They're doing a quality of earnings on flywheel. There's 50 questions. And I sent it to them end of day, Omaha, Nebraska time, and I had answers in the morning. So I think that's an element where, depending on what your internal team looks like, and I have a great internal team right now. I have a fantastic controller, and he would do this, but I know everyone's not so lucky. If you sent your controller or you sent your staff accountant a diligence list at 7 p.m. on a Tuesday and said, hey, I need this first thing in the morning because we've got this deal that we're trying to close, I think you may get some pushback from the team.
Yeah, I was actually just talking to a CFO not too long ago, a client CFO, and he said, the value that I see with Consero is that I can tell you that I spend about 1 week out of the month looking at financials, digesting the information, putting together my board packet. But the rest of my time, 75% of my time, is spent on strategy. And so thank you for giving us the strategic advice that you have today. The topic being 3 tips for your recession survival guide. Thank you for outlining that for us. You're a great friend to Consero. We've worked together, like you said, the flywheel case study and a webinar that we did right in the middle of COVID. And so you've always got great advice, and you are definitely one of those strategic CFOs that folks can listen to and get great guidance. So thank you very much, Steve Isom. Enjoy your fairy nectar. I will be enjoying my the unfiltered wheat Boulevard from Boulevard out of Nebraska as well. And we'll see you next time. Thank you so much, Steve.
Thanks a lot.
All right.